is the closing bell on Wall Street, and now it's market domination over time. We're joined by Jared Blickery in just a moment to get us up to speed on some of the details from the trade. I'm going to start with where the major averages ended the day, which has not much changed. Really interesting past, call it 72 hours, right? Late Friday, Moody's downgraded the credit rating of the United States of America, the third of the three major credit rating agencies to do so. And I thought when we talked to Sam Stovall of CFRA at the top of the show, he described it really well. He said the first time that we got this credit downgrade back in 2011, if you think about a ping pong being dropped on a table, the first bounce is pretty big, and then the bounces get smaller from there. So the first bounce reaction back in 2011 was pretty big. Then we had Fitch downgrade, and then we come to the reaction to the downgrade late Friday, which was relatively muted. Not any new information necessarily for the markets, that the U.S. has a lot of debt and that debt servicing costs are not really coming down. The Dow up by 137 points when all was said and done, about 1/4%. The S&P 500 very little change, just up 0.1%. And the Nasdaq even less changed, up 0.02%. Was there any more movement under the surface, Jared Blickery? Tell us.
Well, I was watching that too. I was trading through 2011. It took 4 months for markets to return to normal. The VIX popped to 50, and it took until January to get back below 20. This is a very different situation. Sovereign debt is not the huge issue that it once was. I was looking at the VIX today, and we'll get to some bond market stuff and some heat maps in a second, but the VIX almost got to 20 on the open, but it's drifting down. I got some more thoughts on that. I'll share with Josh in about 30 minutes. It'll take a little bit of time. Here's the 10-year T-note yield, only up 3 basis points to 4.47%. It was up more on the open. And the 30-year, this has been my North Star. I've been harping on what happens if it goes above 5%. Well, it did not close above 5%, 4.94%, still up on the day, but less than 5%. So we haven't breached that key psychological level just yet. And more on that in 30 minutes as well. Let's check out the sector action. And for there, we have healthcare, very defensive move, but United Health bouncing back. We're just talking to a strategist about that. Healthcare in the lead, not much else making waves, maybe energy trading to the downside, 1 1/3%. But if you take a look at the NASDAQ 100, not a lot of outperformers or underperformers. In other words, not a lot of dark green. Microsoft just barely cracking that up 1%. Apple down 1.17%. Tesla down 2%. But at the beginning of the day, this was a much different picture. Tesla was down about 4%, and this was a very red board. So stocks managed to climb back, and the fact that we were able to overcome this Moody's downgrade in basically one day, and there's going to be a little bit more fallout, but I just think that speaks as to the resiliency and the different character of this market as opposed to 2011. Send it back to you, Josh.
Thank you, Jared. We're joined now by Troy Gajewski, Chief Market Strategist at FS Investments. It's a global alternative asset management firm with over $83 billion in assets under management. Welcome, Troy, to the show. Maybe start where Jared just left us there, Troy, because the news of the day, Moody's makes its move, cuts the credit rating. Certainly, Troy brings into focus and highlights these very real challenges, fiscal challenges, our big debts and deficits. The market reaction, though, Troy, as Jared was kind of walking us through there, was interesting, though, too. S&P 500 at the lows of the session was down about 1%. We actually battled back and finished just inside the green. What does that tell you about this market, Troy? What are the lessons there?
Well, look, I think when you think of the downgrade, right, the bottom line is it's the ramifications of everything we've been talking about in terms of the flow to stock ratio for Treasury issuance relative existing stock, which is the worst by far and away of any major asset class. Minimum of 6, somewhere up to 8, even higher, of all the Treasuries that were ever issued in the history of this country are coming out like clockwork each of the next 10 years. That's a lot of supply. Furthermore, the yield curve going in today and still today still barely has a positive slope at all. The typical yield curve slope is, let's call it 100, 150 basis points between the 10-year and Fed funds. And it can get as high as 2, 3, even 400 basis points in a non-QE world. So duration's been a tough place to be, remains a tough place to be. Yes, you do have recession protection. Guess what? Recession risk never even got that high in the first place. So we continue to have a very dim view of duration. And the Moody's downgrade kind of reignites and re-highlights that to folks, at least temporarily. Now, in terms of equity markets, it's really the flip side. U.S. equities have the best flow to stock of any asset on the planet. You have somewhere between 50 and 150 basis points of supply, sucked out every year because share buybacks, debt financed acquisitions, as well as public to private transactions greatly outstrip any IPO volume or secondary volume. So when you think long term, why has duration been so hard? Even though inflation's coming down, a lot of it gets back to flow to stock and the natural slope of the yield curve. And when you think of why equity multiples almost relentlessly climb, it's because of this very basic technical factor. And to the point your guest was articulating before, just how resilient the U.S. equity markets become.
And is there any reason to think it won't continue to be, Troy?
Well, look, I think when you look at U.S. equities today, and this is really more of a U.S. problem, the valuations are extremely stretched. We know that. That's why when you have these trade war flare-ups or some type of other shock to the system, like the Fed hiking rates dramatically, you can get some degree of multiple compression. All in all, though, it will be unlikely that we have a material decline in multiples without the 30-year probably getting to 5.5 or 6. I think the market can digest 5 relatively well. So the question for investors is, all right, you got your U.S. equities covered. How much do you want to put there? It should be a healthy amount. You probably want to avoid goofy international. You also have to understand that U.S. small cap has turned into a complete adverse selection bias index. And so what do you want to complement your equities with? Arguably something in alternatives. And if you want equity-like returns, well, then you have middle market private equity and evergreen wrappers as a very good choice.
Why, Troy, did you say that you probably want to avoid international?
Yeah, so international, look, it's very basic. Again, so many of these things are very basic, right? You need nominal GDP growth and or a combination of secular trends to drive revenue growth in order to drive earnings and EBITDA and free cash flow growth. And so, Europe's Europe. We're rooting for Germany. Hope that fiscal stimulus gets things done, helps jumpstart that economy to grow at 1 or 1.5, or hey, maybe even 2%. In the U.S., look, we're a 5.5% nominal GDP economy now. So you're getting much better revenue growth, much better earnings growth. And then if you look at the character of the companies, right? Not that there aren't great companies overseas, there's a handful of them, but the most important systemic companies that are traded today are listed in the U.S. and they still have the best growth prospects. So, I get that international is cheap, but it's arguably cheap for a reason. And in the short term, yes, you did have a period of European institutions rotating out of U.S. exposure for very widely publicized reasons. But we think of that as more of a counter-trend rally in the midst of a long-term dispersion of return outcomes between U.S. assets and international assets. And so the beat goes on. It's almost same as it ever was, so to speak.
And Troy, just quickly to go back to middle market private equity for a second. If you're a retail investor, is there an accessible way to get access to that kind of asset?
Yeah, I mean, that's one of the big accomplishments we think of the alternative industry, which we have tried to be a big part of, is allowing investors to have access not just to private equity through evergreen structures, but also to middle market private equity, where you have even better growth trends than you have in the S&P in terms of revenue growth. And so much of the wealth of this country has been generated from first, second, third, fourth generation owner-operated businesses that now bring in private capital, and you could invest in those if you meet the qualified client standard. And we think almost certainly have a better return outcome than U.S. small cap international. We'll see who wins the battle over 10 years between middle market private equity and the NASDAQ or the S&P, but you also have far less downside risk, far less volatility, and it's also a very tax efficient alternative strategy as well, which it benefits from the structure, but also the nature of private equities. You tend to have very few realized gains as a percent of overall calendar year performance. And what is a realized gain tends to be taxed at long term, which, as you know, is much more tax advantageous than ordinary income or short-term capital gains.
Right. Troy, great to see you. Thanks so much.
Great to see you as well.
Well, JPMorgan Chase CEO Jamie Dimon did not announce his retirement today, but he did voice a market warning at the company's Investors Day. Here were the details. Yahoo Finance's David Hollerith. Jamie Dimon giving a warning? I say it ain't so.
Well, so Dimon's, what stood out today of all of what he said, the most important thing is his present concern in the fact that markets could be misjudging the effective impact of tariffs.
It's pretty funny because a few months ago, didn't he sort of say, get over it about tariffs? He said, he kind of, at the beginning of the year, didn't he kind of?
He
but
did.
This was before we got the worst case of the tariff. Yes, exactly.
Here's what he had to say, though. Okay. Take a listen.
My own view is where people feel pretty good because you haven't seen an effect of tariffs. The market came down 10%, it's back up 10%. I think that's an extraordinary amount of complacency.
So complacency was on the whole what he was warning about. And Dimon's not alone in this either. Jane Fraser, she wasn't really talking about complacency so much as how much of a change
the Citigroup CEO.
Everything has happened since the April tariff rollout. And so overall uncertainty was mentioned about 13 times through Investor Day, just to keep track of it. So that goes to show just where the bank is, and their earnings are unchanged. Investment banking, though, looks a little bit worse for the second quarter. Trading also is a little bit lighter than expected.
What about retirement plans? Any more color and commentary there?
They talked about a lot of stuff as far as like, I couldn't tell you retirement plans. Did you listen to that today?
No, I just wondered if he gave any kind of firm answer.
There were potential successors to Dimon who spoke today.
I'm sorry.
His retirement,
not
retirement plans that they're offering us, but his retirement, which is what people.
Although I'm interested in both. I mean, if you mentioned that too.
They talked about both. As far as successors, what he did say, which is kind of interesting, he said everything is the same as it was last year. But also, he said, obviously, if I stick around for another 3 years, which is in line with what he said, but also it's more than the base case could have been. So we got a little more clarity there.
Was it last year that he said like 5 years or something? Was that it?
He said less than 5 years.
Got it.
So now we're in this scenario where the clock is still ticking, and obviously this is a huge thing. He has built the bank into what it is now today. And so whoever his successor is, we need to know, and the fact that they aren't ready to deliver that does leave investors in a little bit of internal uncertainty too. So
For sure. All right, thank you, David. Coming up, Home Depot set to report first quarter earnings before the bell on Tuesday. We'll get you set for everything you need to know ahead of those results. Stick around, much more market domination overtime coming up.
Yields are driving higher today with interest rates remaining elevated, all of which is making the housing sector a tricky space to navigate for home buyers and investors alike. And now a new name is entering the REIT space connected with home building. Millrose Properties, the company just reported its first earnings since spinning off of Lennar back in February. And joining us for more is the CEO and president of Millrose, Darren Richmond. Darren, thanks so much for being here. It's good to see you.
Julie, it's always great to see you. Thanks for having me.
So, Darren, you guys just reported your first earnings. As we said, you spun off from Lennar recently, and your structure is pretty unique within the home builder industry. So first of all, just sort of outline for us what it is you guys do, and then your relationship with the home builders.
Sure. We're the first publicly traded land bank. We provide home builders with reliable and efficient capital. And our platform generally allows home builders to scale their own businesses and to reorient themselves around higher asset returns, which in general should lead to a re-rating.
And so you guys basically hold land until these home builders say, okay, we're ready to buy. I guess the model has been for a home builder, they buy a bunch of land and they hold it for a while until they are ready to build. But that means they have to hold the assets on the balance sheet, presumably for a while, if they're not yet ready to build. This gives them sort of an option to buy the land when they are ready to build?
You're exactly right. A home builder really is two companies in one. It's a land development business, which is their property business, and then there's an operating company, which is really oriented around consumer brand and the products that they plan to build for the benefit of those consumers. And there's a different cash conversion cycle when you're looking at the PropCo, which could be many, many years in the making. And their operating businesses have a very quick cash conversion cycle where they're buying the home site on a just-in-time basis, putting up a house and delivering that house really within 3 to 9 months. So by separating the two, what they're really doing is allowing these two businesses to be in the hands of those investors that are going to value the discrete parts the highest. They're not the first to do this. We've seen, in the hospitality sector, the gaming sector, and the tower sectors, a split of their operating businesses and their property development businesses.
And Darren, who is your customer right now? Is it just Lennar or is it multiple?
Yeah, our customer started out as for Millrose as being Lennar. They spun us off with about $6.5 billion of assets. What that really allowed us to do was have a very consistent revenue stream, earnings profile, and a very robust dividend. And that created the backbone for us to grow accretively with third parties. And so we've done business as Kennedy Lewis with about 17 different home builder counterparties. We're now exporting those relationships from Kennedy Lewis into Millrose. As part of our earnings report last week, we announced that we had 5 strategic partnerships that we had signed up with household names in terms of builders that you all would know. And so we're very quickly diversifying our business away from Lennar. Not that that's a bad thing. We love our relationship with Lennar, but this was very consistent with the profile when we were spun out of Lennar that we would grow with third parties.
And Darren, where are you guys seeing the opportunity right now in terms of location? I was talking with our housing reporter, and she said you could argue that in some places they've overbuilt, maybe a Florida or Texas. And the places that really need housing supply, a place like New York or California maybe, it's really hard to find land to even buy in those places. So how are you guys approaching that sort of geographic puzzle?
Yeah, our distribution is definitely uneven. What we're looking for is a demonstrable imbalance in housing supply relative to job growth. And so so we are looking for those markets where there's a lot of in-migration and job growth relative to housing. And so I would beg to differ a little bit. You're painting Florida and Texas maybe with a broader brush. Certainly there are parts of Florida, parts of Texas where there has been overbuilding. But by and large, the markets that we operate in are really the markets that continue to show real demand. And let's step back. There's a shortage in America of roughly 3 to 5 million houses. And the only way we're going to make up that shortage is really through the new home market. The new home market continues to pick up market share from the existing home market. And so we have a lot of tailwind for us and for our home builder clients.
Darren, I was reading there's a comparable company that does what you all do, Four Star Group, which I guess was taken public, Darren, by D.R. Horton. I'm curious, what do you do, how it all compares and contrasts to what they do?
Thank you. It's a great question. Four Star really is a land developer versus a land bank counterparty. They don't necessarily know who their customer is when they set upon buying a parcel of land. They don't know what the development costs are going to be when they buy that. They don't know what the timing of that land is going to be. And for us, we know exactly who our client is. These are the people that had taken the parcel of land to us. We know who the client is. We know what the costs are going to be because all of our land has cost overruns with our home builder clients. We know what the timing is going to be because we have takedown schedules as part of our option and development agreements with those builders. And so we have a lot of visibility on who the client's going to be, the timing of the cash conversion cycle, the margins that we're going to make because our costs are known upfront. And so what we've really done is taken a 4-star and maybe taken it one step further, where we've separated our income statement from our balance sheet, where our balance sheet is constantly cycling from land to land development to home site to cash. And then our income statement is really just our option rate times our investment balance divided by 12. And so we've created a lot of consistency and visibility in our go-to-market strategy. And that's really what's appealed to shareholders. We've really performed quite well since spinning off from Lennar. And I think it's really the visibility around and the consistency around our revenue stream, as well as the growth that we've been able to demonstrate.
Darren, thanks for being here. Appreciate it.
Thank you very much for having me.
Home Depot set to report its latest quarterly earnings before the bell on Tuesday. Yahoo Finance's Brooke DePalma here with what to expect from the home improvement retailer. So what do we got?
Well, Wall Street expects it's going to be a slow start to the year for Home Depot, most certainly. And that's really as two key points really weigh on consumers, that uncertainty around tariffs and also those elevated home prices, elevated mortgage rates have really continued to create challenges around the housing market, and that's expected to have weighed on Home Depot's first quarter, certainly as potential buyers were spooked off by those higher prices. If we take a closer look at what Wall Street expects here, they still do expect revenue to grow year over year, roughly 8% to $39.29 billion. Adjusted earnings are expected to decline year over year to $3.59. Now, one key area here that all Wall Street has watching is that same-store sales growth number. For 8 straight quarters, we saw negative sales growth for Home Depot, and in the Q4, that number turned around. Now, more bad news is expected on the same-store sales growth front. Wall Street does expect that it did fall during this quarter, down 0.2%, but experts telling me that Home Depot should be a key winner in the long term here. They say that they have this pro business that makes up about half of their customer base. We know that they recently acquired SRS Distribution, that's a professional business segment, for roughly $18.25 billion last summer. So Wall Street optimistic that that pro business will certainly turn the tide here.
And what does Walmart's recent warning, what does that mean for Home Depot, potentially?
Right, well, two key things here is that they warned that tariffs would create higher prices. Some experts telling me that that may have opened up the floodgates here in order for others to say, we too have to raise prices because of tariffs. In addition to that, we also know that Walmart loves to tout that they make a majority of their goods here in the U.S. Home Depot, a similar notion. They said a majority of their goods that we sell are produced in the U.S. Both Walmart and Home Depot, they both have some exposure to China here. And so really, you sort of relating those two, they might have to raise higher prices. We also know that Walmart reiterated their guidance. Could we hear similar, for not just from Home Depot, but Lowe's reporting the following day, and of course Target after that. And so Walmart perhaps might have set a precedent here on what these next earnings could look like.
All right, we'll wait and see. Brooke, thank you. Appreciate it. Time now for What to Watch, Tuesday, May 20th. Starting off on the earnings front, we're going to be getting some more reports from companies including Home Depot, Viking Holdings, and Palo Alto Networks. Home Depot announced the results for the first quarter before the markets open. Analysts anticipating the company's sales outlook to be shaky due to a weak housing market and low consumer confidence. Commentary on tariffs will be in focus on the earnings call as Home Depot imports around 40% of its products.
Taking a look at the Federal Reserve, another round of Fed speak is coming up throughout the day tomorrow. This coming after comments today from Fed Vice Chair Philip Jefferson. He said Fed policy is in a good place and that there is room to be patient. This all following a relatively tame inflation print last week, with the year-over-year rate coming in at 2.3%, its lowest since February 2021.
And finally, Google's annual Google I/O Developer Conference is kicking off tomorrow. Investors keeping a close eye on any insight into Google's product pipeline or AI updates from the company's Gemini platform at the conference.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of break, it's asking for a trend. Got you covered for the next half hour. The latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.